Good morning, everyone, and thank you for joining us for the QPM Energy Investor Webinar. I'm Jane Morgan, Investor and Media Relations Manager, and today I am joined by our CEO, David Wrench. David's going to be providing an overview of the recently announced investor presentation, followed by a Q&A session. So to ask a question throughout today's webinar, please use the Q&A function, which can be found at the bottom of your screen. David, I'll hand to you.
Yeah, look, thanks, Jane, and thanks very much, everyone, for joining the webinar this morning. Look, I'd like to spend a little bit of time talking through a series of significant developments that we've announced in recent days relating to, a very significant step forward for our business that we have been working towards for some time. And the specific things we're talking through today will be relating to the launch of what we're calling our ASX Energy Hub, and specifically the first stage of that development, which is the development and construction of 112 megawatt power station, new gas-fired power station, the ASX Power Station. So it's a very exciting time for QPM Energy. We've been working pretty hard over some time to achieve these goals, and we're now moving into the next phase of growth for our company. So a little bit of background to QPM Energy. We believe we are very uniquely positioned, and we call ourselves an integrated energy utility. And by that I mean integrated means we produce and manage a very large gas supply and reserve portfolio. We supply gas to customers who use that for various industrial purposes, but importantly and specifically, we also manage a portfolio of gas-fired power stations, and we in fact are currently dispatching 2 power stations with about just over 172 megawatts of capacity. So this business is already, a very interesting integrated business, and that business generates revenue from both gas sales and electricity sales, generation and sales. And the specific area that we're talking about today is the launch of the ASX Energy Hub, which is the next stage of our business and particularly focused around growing our electricity generation portfolio. The hub itself, we're developing a pretty unique asset that really is able to develop and deliver flexible electricity generation and storage services, both for gas and electricity, really to support Queensland's energy grid, and specifically the transition that the grid is going through at the moment towards a lower carbon generation platform. We've completed a feasibility study into the first stage of this development, which is a new gas-fired power station. And the feasibility study shows that it's actually this new first step has very, very, very attractive economics with some very robust cash flows. So our strategy and our plan to grow our business is based around our 2 foundation assets, which is the Townsville Power Station and the Moranbah Power Station. The Townsville Power Station is a 160 megawatt gas turbine located in Townsville that we have been dispatching now for the last couple of years. And the Moranbah Power Station is a smaller power station in Moranbah that we've been dispatching. We acquired the rights for that power station back in December last year. So these 2 assets remain an important part of our portfolio. And what we're now talking about is adding to that portfolio another 112 megawatts of gas-fired generation at the ASX Power Station. This power station will run slightly differently in that it's intended to run slightly longer and be a core asset for us, in fact, our priority generation asset. The infrastructure that we're using and will develop to support the first stage power station will also support further expansion. And we have capacity both at our site and also at the grid connection point to expand up to 300 or 400 megawatts at this particular location, which will give us an overall portfolio approaching 500 megawatts of managed generation. And that's a very significant portfolio. It's about 5%, roughly 5% of the current Queensland generation capacity. So it's a very major portfolio and a very important asset for our business. How that looks in terms of revenue. So In FY26, we have two revenue streams from gas sales in the grey there, and green is electricity revenues. About 60% of our revenues will be already coming from electricity generation. And as we add the Isaac Power Station, that will grow towards 80% of our revenues are directly from electricity sales. So by building out our capacity, we're moving ourselves into and increasing our exposure to a long-term electricity revenue or long-term utility type market where we have very, very long-term sales of electricity and also very long-term reserves that underpin the generation that we use to produce the electricity. So we are aiming to set ourselves as a different type of business. Yes, we're a oil and gas asset operator, but that really is the platform for really how we make our money, which is through electricity generation. So I'll talk a little bit more specifically about the power station, the Isaac Power Station. And all of our assets that we're talking about in the Isaac Energy Hub are located on our site that we own and control in Moranbah, just out of the town of Moranbah. So Moranbah is located in central Queensland, inland, about 200 kilometres inland from Mackay. It's the heart of the Bowen Basin, or the northern Bowen Basin, steelmaking coal producing region. And the gas that we produce and manage from this group of leases around the Moranbah area is hosted in the coals that the coal miners are actually also producing. So it's a very, very well-defined resource and reserve, and we currently have over 435 petajoules of 2P reserves, which is a large reserve position, in fact, one of the largest positions in Eastern Australia currently. We already have a big producing well field, about 130 wells. We also have a number of tie-in points where we accept and manage what we call third-party supply, and that's gas that is from that's being pre-drained or drained by mine operators ahead of their coal mining activities, and we provide a pathway for that gas to be taken off their lease, and we manage it from that point. There's also a lot of infrastructure that's required to make all that happen. And importantly, we also own and operate a large gas processing and compression facility. And that's the main collection point for all of the gas that we produce or we accept comes to a central point. We compress it and process it. We supply directly to customers, specifically Dyno Nobel, who is our foundation gas customer. But we also have access into the North Queensland gas pipeline. You can see that particular pipeline on the map on the right-hand side there runs from Moranbah up to Townsville. It's almost 500 kilometres. And that's how we transport gas to Townsville to run through the Townsville Power Station. So our portfolio of assets is pretty unique. And what we're doing now by adding the Isaac Power Station is building on that portfolio by adding new electricity generation. The feasibility shows that the new power station will generate about $70 million of revenue annually over its life, and an EBITDA of around $49 million a year. So it's a very significant asset for us and our business, and it adds, incrementally substantial revenue and earnings for the company. The life of this project is at least 30 years. Our reserve position is sufficient to go for way beyond that, and the particular generation units that we will deploy here have very, very long lives as well. Beyond that, we're looking to add incremental generation capacity at the same site. And probably initially that'll be a large battery or a utility scale battery, maybe 100 megawatts with potentially 4 hours of storage capacity. And that perfectly complements the new gas-fired power station, because we can run that power station longer, and instead of dispatching into the grid at periods of low price, we can store in the battery. So what we're doing here is having a flexible system where we can store both gas in the pipeline and power in the battery, and all that's about driving maximum generation during the peak times in the market, which I'll talk about in just a sec. There's then also capacity to add further gas-fired generation, up to 300 megawatts on our site. So you can see that this development of this hub has potential to be a very, very significant energy asset for Queensland. Just some specific operating parameters for the power station. The picture on the right-hand side there is our existing site. So in the middle there, you can see there's 4 large compression units that are our main compression station that we operate. The layout to the top there, the grey area to the top there, is where the power generation units will go. The first 2 of those, stage 1, is what we're talking about specifically today. It's got 111.6 megawatts of capacity. Then there's transformer and switchyard there, and there's a pink line you can see that runs, and some pink dots if you've got very good eyes. That runs about 2 kilometres to the main Moranbah substation, which is our grid connection point. There's substantial room for a large battery, you can see there on the plan, as well as heaps of room for additional infrastructure as required. We own this site. It's perfect for us because all of our gas supply comes here. We can manage our pipeline storage, we can manage battery storage, and we can also blend gas that we get from different sources, which is an important aspect of our business. So the power station itself, the feasibility study has modelled a over 30-year life. It consumes about 1 to 1.0 terajoules per hour, and we're intending to run it about 10 hours a day. So about 11 terajoules every day, 4 petajoules a year. That unit will dispatch around about 380,000 megawatt hours a year. So it's quite a significant energy asset. Just to put that in context, for the FY26, we're expecting to dispatch about 200,000 megawatt hours from the combination of TPS and the MPS units. So in terms of the economics, the key variable here is the electricity price, clearly, and the way that we've thought about, or the feasibility study has estimated revenues, is based around 2 pricing periods: a 4-hour period, which is at peak pricing, and that for the first 5 to 7 years of this project is somewhere in the order of $250 to $260 a megawatt hour. And then for the balance of the 6 hours that we're intending to run, we're using a shoulder price, which is around $140 a megawatt hour. The price assumptions that we've used have been provided to us by an independent energy market consultant, and who have done very, very long-term forecasts for electricity prices in Queensland. And so we've used those numbers as our assumptions in the model, and that generates about $71 million of revenue annually. The operating costs of the power station relate primarily to gas supply. Now, this gas supply is from our gas field, and that cost of supply is around $4.50 a gigajoule currently, so it's about $18 million a year. The power station operating and transmission costs are about $4.4 million a year. So the short-run marginal cost, which is the actual cash costs of this power station dispatching power into the grid, is something just under $60 a megawatt hour. So that's a very, very competitive dispatch position, and it means this power station is going to be a very competitive generator into the Queensland grid. In terms of the valuation metrics that you might apply, so about $49 million of average EBITDA or operating earnings a year. It's got a strong NPV and very solid returns in terms of internal rates of returns, both ungeared and geared. The importance of those, the feasibility study really is that it shows that the project generates strong cash flows, which can support a very significant project finance debt facility, which will be important to fund the capital cost of the build of the project. The other aspect that has not been included in the feasibility study work is the inclusion of additional electricity generation by running the power station longer. We've capped the power station's runtime at 10 hours a day. This power station also has the capacity to use lower quality gas, and that specifically could incorporate the use of mine waste gas, which has been diluted during the mining operations, and it can run through this particular power station. So we've got a number of areas where we think there will be upside over time in terms of increased generation and revenue. Just to sort of, if you like, benchmark the feasibility at revenue assumption, the annual revenue assumption, we've actually done a bit of analysis that looks at this running this power station, assuming that we'd run the power station on the basis that we're intending to dispatch it over the last 4 years, and looked at what would the revenues have been based on actual market pricing. So over the last 4 financial years, so FY22 through to FY25, the project would have generated about $76 million a year on average. Now, that compares with the feasibility number that we're using for revenue of around just over $71 million. So we're fairly comfortable that the pricing and price assumptions and the revenues that feasibility study is showing is pretty consistent with what our actual experience has been and what the market experience has been, certainly over the last 4 years. So we think clearly QPM's view is that Queensland electricity prices will continue to be quite volatile and increasingly so. And that's one of the reasons why we would like to develop this asset, because it's ideally situated to participate in that upside. So we suspect that our revenue estimate will be somewhat conservative over the long term. This is, again, another way of looking at electricity prices in Queensland, but this is the average electricity price, and this is every 5 minutes over the last 4 years. So for that same 4-year period I talked about earlier, but this is what it actually looks like every 5 minutes of the day. And you can see there is clearly what's called the evening peak, when prices are very strong, and typically that's when coincides with dusk, effectively, and then overnight prices remain strong through to the next morning, when you do get a morning peak, and increasingly in Queensland we're seeing a much larger morning peak. And then you get during the day, of course, the market is dominated by solar generation, which depresses prices. So the window, the blue line there that you can see is $60 a megawatt hour, which is our short-run marginal cost for this asset. And so you can see that this asset has the potential to run profitably a lot longer than 10 hours a day, probably run closer to 16 hours a day and still be making a positive margin. Clearly, we're targeting a 10-hour period that attracts the highest pricing, or is coinciding with the highest price part window or part of the daily price curve. But you can see there is scope here for upside in revenues by running the power station longer. In terms of capital costs, the project, it's about a $200 million project. The bulk of the cost, about $175 million, relates to the supply and installation of the generation units, and I'll talk about those just in a little bit. There is a cost to connect our generation, the site, to the substation. It's about $11 million. We need to modify some of our gas delivery facilities to supply gas to the power station, but overall it's about $195 million in total, plus a contingency. Now, a large proportion of the cost, or the capital cost, is largely fixed because it's subject to a fixed price supply contract for 2 generation units, which we've entered into with GE. So the risk around the capital estimate, we believe, is very manageable and quite low, given that the bulk of it is actually underpinned by a fixed price contract. These are the specific units. So this is it. There are 2 of these. These are 55.8 megawatt GE turbines, and we've acquired these plus the generator. So there's a turbine that drives a generator, and they are what's called aeroderivative turbines. So they're fast start, so they can go from 0 to full load in around 5 minutes. They're an ideal unit for the application that we're looking to deploy them for. And thankfully, we've been able to secure 2 of these, and we've paid. In fact, we've now got a contract in place, and we've paid the initial deposit for these 2 units. That contract has these units turning up in Australia, ready to be installed at the end of the first quarter next year. So it's important for us. It was very important for us to secure these, because the market for this type of unit in particular is extremely tight, and it's driven by the explosion in power demand from data centers and for AI processing. And lead times for these units are now, if we didn't grab these 2 that are available, sort of out towards over 5 years. So for us, this was critical because it underpins the project, and it underpins our schedule to deliver this project by mid-2027, which is our current target. So where are we at and what's next? So we've got a contract to acquire the turbines we've just talked about. We're working through final approvals, and that work is in progress. The grid connection, which is another important element of the project development, is also underway. We're working with Powerlink, who are the transmission system operator, and we have an application which is currently well advanced in terms of the engineering work that's required to facilitate that connection. And there's an element here where we are also looking at offtake, or selling some of the output from the power station to a market participant. And what that does is allows us to effectively lock in a fixed price for a portion of our electricity production. And that's important because it links back to debt finance, because financiers will clearly want to see a portion of our revenues fixed and stable from a highly credit-worthy counterparty. And that really does help us finance and raise the debt required to develop the project. So there's a number of work streams that are continuing. We're very pleased with the way that this work is unfolding, and we're looking to be in a position in October, November, to take a decision, the FID decision, which is the financial investment decision, to commence the construction of the project. Just talking about the financing. So the feasibility study, as I've mentioned, shows that the project generates very strong cash flows, and it does provide a platform for a low-cost funding package. We've been working with RBC Capital Markets for some time now to arrange a funding and offtake package for the project, and we're well advanced on that package, including with project lenders, offtake, and equity partners. Again, we're looking to bring these elements together over the next few months, and then effectively kick the project off in terms of the final components in later this year. I guess just briefly, this project is actually, again, I think, quite unique, because it's going to be one of the very few projects that can be delivered within the next few years that is in line with both federal and Queensland state government policies and objectives. It's very clear that both federally and at the state level, there's been a recognition that gas-fired power generation is a really important component to manage the transition to a low-carbon grid. And it's, in fact, in our view, it's essential. And this is one of the very few projects in Queensland that will actually be up and running in the next couple of years. So we're very, very pleased that we're getting strong support from the state. And I think it will be an important asset, in fact, for the state to help manage the Queensland energy transition. I think I just want to step back a little bit and say, well, from the QPM Energy, we've actually already achieved a lot in terms of building our business and developing our strategy. And I think it's just worth recapping that. So the underlying asset, the Moranbah Gas Project, was acquired back in August 2023, just a little under 2 years ago, amazingly. And since then, we've been doing a number of things. Probably the most critical has been a lot of work's been done around operations improvement and reinvigoration of the gas field, and that's been highly successful. And that work is actually ongoing. So we're continually improving and optimizing the way our wells work, the way our gathering system is operating, and we're seeing incremental improvements in production pretty much every month. A lot of that work has also enabled us to be in a position to upgrade the reserve position of the project, which is, as I've mentioned earlier, about 435 petajoules. And that's been, we're now a very, very large gas project. And that then has enabled us to, complete the feasibility study for the power station on the basis of having a very long-term secure gas supply to underpin the economics of the power station. So all of these achievements are very important building blocks that have enabled us to launch the projects that we're now moving into. From a commercial perspective, we inherited 2 contracts for the North Queensland Gas Pipeline and the Townsville Power Station dispatch. We've managed to renegotiate both of those contracts, and actually, as of yesterday, we've just started the new contract terms, and that's been a milestone for the company because it has enabled us to reduce the cost base of the business very, very significantly over prior years. So the financial year 26 that we're just into now, we will have a much lower cost structure and a very profitable business for this current year. The other major issue or the other major development for the company is the Townsville Power Station itself has been undergoing a major overhaul, and we've, I think, disclosed this and talked about this for some time. That work is pretty much at its conclusion, and it's just going through its final checks and fine-tuning effectively before it gets commissioned later this month. So that's broadly in line with our expectations. So we're expecting gas to flow to the power station in coming weeks. We talked about the FID. Our target there is towards October this year. And then clearly we're looking on the current schedule to be commissioning the Isaac Power Station in mid-27. So we've achieved a lot, and that's given us, I think, the basis and the competence and the capability organisationally to take this next step, which is a significant upgrade and increase in the company's revenue and earnings. So just briefly, operational update. We talked about the TPS overhauls, and that is really, we're looking to see that unit commissioned in this month. And we've been ramping up production in readiness for that. So we've got a lot of gas stored in the NQG pipeline, in North Queensland Gas Pipeline already, and our field is ramping up. So we will be ready to go to dispatch, to maximise the dispatch of the TPS as soon as it's available. From 1 July, we will be moving into this period where we have new contracts, as I mentioned, and we're going to be continuing to grow production through we're drilling some new wells. We'll be continuing to debottleneck our gathering system and optimise, as I mentioned, and we've got a very significant workover program that's just about started and underway in the field at the moment. So we've got increasing upside in production, and we'll then be able to optimise that production through the Townsville Power Station. So we think we're going to go into a fairly strong period of revenue generation for the company in the current year. So in terms of specific guidance, we're guiding gas supply for the year somewhere between 10.5 and 11.5, 10.6 and 11.3 petajoules for the year, which is either side of 30 terajoules a day. Of that, about 7.4 petajoules will be sold as gas, or just as gas, delivered as gas to predominantly that's to Dyno Nobel in Moranbah, and we'll dispatch somewhere around 200,000 megawatt hours of electricity for the balance of the gas generated from the balance of the gas that we'll produce. Field operating costs around $45 million, including royalties, and that's been very stable over the last few years. This is where the big cost improvement has occurred in the transportation and electricity dispatch costs. So those numbers are about $30 million below the equivalent costs for FY25. So there's a very significant saving there, which results in a unit cost in terms of gas supplied for power generation of something like $7.31 a gigajoule, which is quite competitive. You will be aware, shareholders will be aware, that we have just announced the completion of a placement and intention to offer a share purchase plan for shareholders. The placement was raised $10 million, and we issued those shares at 3.1 cents a share. And we're now undertaking a share purchase plan to raise approximately $2 million at the same price, which is open to all shareholders. We're very pleased with the way that this, or certainly we're very, very pleased with the support we got for the $10 million placement. It was well supported by our larger shareholders, and it's been really great to see that they're actually backing the company as we embark on this next stage of development. So we're very pleased with the outcome of the placement, and we would really encourage shareholders to also take up their participation in the share purchase plan, because we do think this is a great time and an ideal opportunity to help us and manage and increase an investment in this company. The details of the share purchase plan are, as I mentioned, it's 3.1 cents per share. There are certain application amounts, and I believe the documentation will be going out on Friday. We would certainly encourage shareholders to participate in that plan. So, Jane, I think that's the presentation I wanted to cover, but I'd be more than happy to answer some questions and take it from there.
Absolutely. I might actually just get you to stop sharing your screen now if you can, David. Great presentation. And again, please use the Q&A function, which can be found at the bottom of your screen, should you have questions for David. Bear with me, there are lots of them coming through. So first up, what other gas turbines have you considered? And what was the rationale for selecting this one over others? Was it higher availability, delivery timeframes? And sort of secondly, how do these turbines compare to existing ones at MPS and TPS?
Okay. There's a couple of things. We've been looking for the right piece of generation turbines or generation units for some time, as we've been developing the plans for the project. The challenge we've had is, as I mentioned, that it's almost impossible to find units, given the demand, across the US and out of the Middle East for these type of units. So these units became available, and they're actually, in fact, thankfully, perfect for what we want to do. The critical thing with them is that they have very fast start time, so it's 5-minute start time, which is important for us and the project. Secondly, they are designed to be started frequently, so they're designed to actually stop and start frequently to match what we see happening in the market, and that's another ideal attribute of these units. And they have long run times between major overhauls and services, so they're great units for this specific purpose. They are a little bit different from, say, for example, the Townsville Power Station gas turbine. That's a Siemens gas turbine, not a GE gas turbine, and it's more of an industrial gas turbine that's not really designed to be started and stopped frequently. So one of the issues with the Townsville turbine is that it's a good unit, but we're only able to start it 1,250 times before a major overhaul, like the one we're just going through currently. So the difference between the Townsville Power Station and the GE units who are intending for the Isaac Power Station, the Isaac Power Station units start faster, more often, more frequently, and have a much longer run time between major overhauls. The Moranbah Power Station is not a turbine; it's a reciprocating engine, small station, and it runs well. It's good units, again, but slightly different mechanical unit.
Thanks, David. Sorry, bear with me. There's quite a few coming through. So next one here. How should we be thinking about the growth opportunities for the Isaac Power Station? So how does further growth at IPS compare to the BESS development?
Well, I think the growth at IPS in terms of adding additional generation is going to be challenging, certainly in the next 4 to 5 years, simply because of the lead time to acquire new units. So So I think the next stage for us will be a BESS. And the reason that the BESS makes sense is that by running the power station longer, we can burn more gas, but we don't necessarily have to dispatch that electricity that's generated at a lower price part of the curve. So if you recall the shape of the daily price curve, we can run longer, but we're getting lower prices the longer we run. But if we can run longer and store that electricity, we can, in a battery, we can then dispatch the battery again, targeting the highest price part of the window. So our view is that a battery paired with the first stage of the Isaac power station is actually an ideal way to expand our capacity and do that relatively quickly. And then we've still got options, further on to add generate more gas-fired generation as units become available.
Thanks, David. Look, there's lots of discussion here just around batteries and obviously the growing number of battery projects. Let me just pick one of them. So, how will that impact QPM strategy moving forward? And what advantages does the IPS have over battery projects?
Yeah, look, I mean, clearly there is a need, and I think the Queensland government in particular has recognised there's a need for increasing levels of support for the grid, particularly during the transition periods between the solar window and into the evening in particular. And that's going to involve more batteries. Clearly, there's potential for pumped hydro. All of those mechanisms are a way of storing energy during the day effectively and then allowing that to be discharged at night. So they all are required. The difference with the Isaac power station is that we can run for such a long time. Typically, batteries are running or discharging, I should say, for, say, 2 to maybe 4 hours. But the Isaac power station can run 10, 12, 16 hours a day. So we're able to run a lot longer than a typical battery can do. And therefore, we're able to cover a lot more of the price curve every day. And we can be very consistent. We can run every single day at the same time and dispatch for 10 hours. So I think batteries are needed, absolutely, as is gas-fired generation. And particularly gas-fired generation, I think will play an increasing role overnight when, particularly in Queensland in the 2030s, when coal-fired generation starts to retire. And at that point, you will definitely need generation that can run overnight, which actually a gas-fired power station, and particularly Isaac power station, is well set up to do. So we think it provides some of the same attributes as a battery, but it also has extra advantages in its ability to run longer.
There's just a comment here about the recently disclosed 5.1% stake in QPM from Sandon Capital. The question goes on to say, is the management team engaging in any communication with them regarding governance or long-term strategic direction?
Yeah, look, we were very pleased to have Sandon, as a significant shareholder, and we have a great dialogue with the team. I've known them for some time, for quite a long time, and they really are very, very aligned with our strategy and for our business, and they've been a very supportive shareholder and in fact have supported the last capital raise. So we're pleased to have them as a shareholder, and we enjoy engaging with them, and they're very, very thoughtful investors, and it's good for us as a business to have a good shareholder base that supports us like that.
Thank you, Dave. So next one, what level of debt funding is being considered for IPS, and how will the equity balance be funded?
Look, that's a good question. So the debt sizing for the project looks like it's around about $150 million of debt. The balance of the capital, we're looking at a range of options for that, and clearly there are a number of ways that we can fund the gap between a pure project finance and the overall capital cost. And some of the opportunities that we're looking at are around engaging with market participants who actually do need to have this kind of generation in their portfolios, and the support that we can provide during those critical peak times of day. Now that actually frees up value for us, because there is a potential to earn or be paid a premium or an option fee or a capacity charge, which would help us offset the capital cost of the project. So there are a number of avenues that we've got available to us to fund both the debt and the balance of the funding required for the project. And we've got advanced discussions going on a number of potential pathways there.
Thanks, David. Sorry, there's quite a few coming through. Bear with me. Few questions here just on risk. So what are the key risks facing the company from now through to commissioning of IPS stage 1? And what are the mitigation strategies for those risks?
Yeah, look, so in terms of the process for the power station, the development of the IPS, the key risks are around ensuring that we get all of our approvals completed in a timely manner. And there are two legs to that. One is the approval or the offer to connect to the grid, which is we're working with PowerLink on. We think that's a relatively low risk because it's a net. The IPS will be a net positive for the grid because it will provide support to the grid, which is needed particularly in the Moranbah area. So we think that's a low risk. As is the granting of development approvals, and environmental approvals. So we're already well down the path on both of those processes, and we don't see any material issues at this stage that will be apparent. Given that we're developing the power station on a brownfield site, it's located next to our existing infrastructure. We're not doing any material clearing. We don't do any clearing at all. It's actually on a hard stand area. So we think those issues are also manageable. However, there is a process that we have to follow, of course, which we'll do. And the timing of that is a little bit out of our control, but we're quite confident that we'll actually achieve both grid connection and approvals in a timely manner.
Thanks, David. As I mentioned, there's quite a few questions on risk, and you did cover this in the presentation, but what are the regulatory risks associated with the Queensland wholesale pricing? So what are the chances that the Queensland government will put the price cap on wholesale prices?
Yeah, look, so the wholesale market, the electricity market, or the national electricity market, is actually managed and regulated by the Australian Energy Market Operator. So the Queensland government actually doesn't have any ability to influence wholesale prices. And in fact, there already is a cap that AEMO has in place for the wholesale market. That cap actually just went up as at 1 July. It's $20,300 a megawatt hour. So there already is a cap. The market already operates under that on that basis, but the cap is $20,300. I'm not aware of any intent from the Queensland government to do anything with respect to market pricing, and in fact, I don't think they're able to because it's not they don't manage the market. It's actually managed by AEMO.
Thank you. There's just another question here. Just is QPM seeking funding under the state government low emissions investment partnership program?
We're not seeking funding under the LEIP, the Low Emission Investment Partnership, for this project. We are looking at potential other projects, and mainly they're linked to projects which would facilitate connection of mine waste gas sources into our MGP project asset. So they're quite separate to this power station development, and so specifically for that, LEIP funding would not apply.
Thank you, David. Next one. So the chart shows TPS revenue around the same levels. Will the dispatch profile look pretty similar to now once Isaac is commissioned?
Yeah, no, that's correct. So effectively, our intention is to continue to dispatch the Townsville Power Station and the Moranbah Power Station pretty much the same way as we have been, or consistently with what we have been doing, and then we're just adding in the Isaac Power Station. So one of the other reasons for wanting to develop the Isaac Power Station, of course, we want to increase our production, and we have to have a good way of monetizing that incremental production, which the power station is, and that allows us to actually start to grow production above where we are today. So we need to have a power station available so that we can increase production, and then what we're looking to obviously do is dispatch that full portfolio of 3 power stations Isaac, Townsville, and Mooroomba.
Thank you, David. Again, bear with me. There's quite a few coming through. So this one's just on the strategy for paying down the debt. The question sort of asks, are there any other asset opportunities in the near term as well?
So the debt financing, specifically, that would be debt financing linked to the IPS, the power station project. Looks like that at this stage the cash flows are robust enough to pay down the bulk of that debt within the first 5 years of operation, and then the project would essentially be unencumbered from a debt perspective. So it's quite a robust project. I mean, you can see any project that generates $50 million of operating cash flow a year is a pretty strong project, and that allows us to pay the debt down plus interest over a 5-year term.
I'm cautious of time here, so let me just try and wrap these up. There's a question just here on how the feasibility study stacked up compared to the board's expectations.
Look, the feasibility study was, well, I guess the board, we had a strong view, and this is based on our experience really over the last 2 years of running and dispatching the Townsville power station in particular, that we were seeing that we were generating very strong, effective gas returns by monetizing our gas by converting it to electrons compared to just selling the gas. So, for example, over the last 2 years, we've averaged about $20 a gigajoule, there or thereabouts, for that gas that we've essentially converted to electrons and sold into the market. So the board was very clearly behind the strategy of increasing the amount of generation that we manage, because it's by far the most attractive and highest margin pathway for us to monetize the revenues or the gas that our gas reserves. So the board's expectation around revenue was pretty much bang on with where the feasibility came out, because that's what we've experienced historically, and that you can see that chart that I put up earlier showed that. In terms of the costs, the operating costs are pretty much in line, and the capital costs came in at around about where we had a high-level scoping study which used sort of industry metrics for capital costs for this type of project, and it came right in line. So as a result, the board's been quite comfortable with the project and the risk profile, because it's been very much in line with our expectations, both in terms of revenues, capital costs, and operating costs.
Thank you, Dave. Then this one's come through a few times, so I do want to ask it. Who are some of the potential off-takers for IPS? So what kind of companies would they be? Mining or industrial? Perhaps you want to comment on that.
Yeah, we're in discussions and negotiations with Campos. I can't reveal too much, but they're typically, well, they are energy market participants. So they are participants already in the energy markets, and they're highly creditworthy entities that are very large, in fact, participants already in the energy market. So we're not talking about supplying electricity to an end user directly, where we'd be looking to supply it to an energy market participant who is managing a large portfolio of both generation and their wholesale and retail client customer base. So the key challenge for us, or the key objective for us, is to ensure we have a good, strong offtake with a very creditworthy counterparty.
David, mindful of time, I know you've got to run off for another meeting, but looking ahead, financial year 2026 and beyond, what are the catalysts that investors should be looking out for, milestones?
Yeah, look, I think we're setting ourselves up for this next 12 months to, from an operational perspective, we're looking to continue to grow our production. From a financial perspective, start to show that the business has an ongoing and strong, profitable platform to build from. So that's our objectives, both operationally and financially, in the current year. And clearly, from a project development perspective, we're looking to hit some of the key milestones for the IPS development, and that'll, of course, be the relevant approvals that we need, FID being able to take fit to continue to develop the project. And of course, we're hoping to see two large new gas turbines landing on our site sometime in Q1 next year. So there's some pretty significant milestones that we're working towards over the next 12 months.
Look, wonderful. I didn't even make note of all the congratulatory messages that we did get off the back of that. But that is all we've got time for today. If we didn't get to your questions, please feel free to reach out via the contact details, which can be found at the bottom of the ASX releases. A recording will be available, and thanks for joining us again.
Thanks, everybody.